What's going on, guys? It's a very important video. Today we're going to be talking about using the wheel strategy on one of my favorite stocks, SoFi. And I'm not sure if you knew this, but you can make $10,000 or more per month running the wheel on SoFi. It's one of the most consistent strategies that you can use, and SoFi is a great growth stock. So in this video, we're going to go through step by step on what the wheel is, why SoFi, and how to successfully run this for yourself. So let's jump right into it. So if you want to retire early with this simple, reliable income strategy, it's really a good combination. SoFi plus the wheel. So the wheel is essentially pretty simple, right? The wheel is a process and a system of selling options to get into a stock and get out of the stock and just continue this system. So the wheel strategy on SoFi is a good way to make safe passive income. And my lifestyle has actually been pretty stable because of the wheel strategy. And using it on a bigger portfolio, of course, generates well over $10,000 a month. Some months I make $100,000 or more. But yeah, obviously you can scale and grow your portfolio and get to the same place as me eventually with time. And it all starts with consistently growing your account. So what is the wheel strategy? Well, it's essentially like a Swiss Army knife of option trading. It has all the tools within it to build in passive income, safe income, reliable income, and you don't have to waste a lot of time doing it. It's not a full-time job. You sell a put, you just wait until expiration. And if you're assigned, then that's cool, right? So there is really nothing bad that can happen with the strategy. Unless the stock market crashes, but then everyone's in a hard position, the wheel strategy would actually outperform in a bad market. So neutral markets, the wheel strategy would really shine. You would outperform the market a lot. In a bull market, you would make consistent income, but you may underperform if the market rises 50%. So you pretty much want to stay in this zone, which is your normal zone, right? We want to stay within the normal zone. Of course, this green area would really be the best. If it's extremely bearish or extremely bullish, you don't want to be in either extreme case. You want to be basically here, and the market's always slightly bullish. So this is the base case anyways, all right? This strategy only takes 1 to 2 hours per week at most. Honestly, it can take even less, especially as you get better at this strategy. You just open up position, you close it. On my Monday and Wednesday calls in my coaching program, I just do 45 minutes Monday and Wednesday, and it's plenty. And the only reason I even go that long is just to educate others on my group sessions. So it's a very easy strategy. If you're a busy professional, this is like literally the best strategy for you, which is the wheel. On SoFi, as well as NVIDIA and other stocks, I have a video on NVIDIA, very similar to this one, but you need to listen to SoFi because I think SoFi has an interesting angle that I'll get into in just a moment. So yeah, selling options is really consistent. It's way better, obviously, than buying options. If you're still buying options, you're not consistent, and I'm glad that you're watching this video right now because I'll put you in good shape. Time decay, by the way, really hurts option buyers, especially in the last period of time. You see how time decay really accelerates. So yeah, when you're buying options, you're fighting against time decay, but when you're running the wheel is just selling options. You're selling puts, you're selling calls, and you're just in that selling mode, man. You're just selling and getting income. So when you're selling options, time decay is your friend. It works in your favor. So it's really, really good stuff. Now, for making your money work for you every single day, this is the best strategy. And here's the 4 steps to the wheel strategy. Step number 1, you sell put options. Step number 2, you get assigned stock, maybe, right? Not always, but if it goes into the money, at expiration, you get assigned. That's completely okay, right? If you get assigned, you go to step 3. Step 3 is you sell covered calls. Okay, so you have 100 shares now. In step 2, you got assigned. So now you sell covered calls, right? Now, if you get assigned on covered calls, you're forced to sell your shares. It's all good. Just rinse and repeat. You go back to the wheel. That's what it is. It's as simple as that, right? So you keep it simple. So why SoFi is perfect for the wheel strategy? I really like the business fundamentals of SoFi. Like you can kind of see here, members are just growing at a very fast rate. If I zoom in here, new member additions, it's just compounded growth. Like you can see what compounding actually looks like from this chart alone. So since 2020, they had just a little bit over 1 million users. And now in 2025, they're already over 10 million users, right? This was from a quarter ago. So now they're over 10 million users. And this is great, right? It's a growing trend and they're gaining more users. So banking and financial industry is very strong, and I'm very bullish on the strong fundamentals that the business has. If you look at it, they have a fully digital bank with actual bank charter, so there's no need for physical branches, but they still have all the benefits. So they have engineered a way to make a lot of money with the financial side of things, but then also in a techie way, right? So their technology stack is amazing. Their engineers are very good, and they have multiple revenue streams, whether it's lending or banking and investing. They have lots of income coming in. And the main thing that I'm bullish on as a business model is their upsell model. So the upsell model is basically they have learned how to acquire customers at a very low cost. So their cost of acquisition, or CAC, is very low. So if they're able to get in a lot of people in the door, they're essentially using a strategy called blitz scaling, which is they're putting all their money at customer acquisition. But the good news is, unlike a lot of dumb Silicon Valley companies, SoFi isn't like that. They're a more mature business. So once they have low customer acquisition, they're also very good at converting these customers into more products. So that's what you want to see from a business is, are customers doing more business with this business? Are they coming in? For example, think about it at like a restaurant. If a customer comes in, they eat at a restaurant, are they going to come in again? Or, are they just a one and done? You don't want someone to be one and done. And SoFi is a perfect example of the latter, right? The customer comes in every single day and they're a regular, right? And then they, buy drinks and recommend their friends, and that's SoFi. That's where they're at. So SoFi has a lot of growth, great brand, and great business model, amongst other things as well. So yeah, it's perfect for option trading as well because SoFi has high implied volatility. High implied volatility means that there's higher premiums. Higher premiums means that you collect more money. That's all it is, right? So there's also excellent liquidity and volume. So you're able to trade SoFi very easily. You can get into the stock very easily by selling options, but I can show you what that looks like. If I go right here into SoFi, I'll show you that there's just a lot of volume on the stock, making it very easy, as well as I've been saying to buy the stock for many months now, and over the last 3 months, it's up 85%. So you have been running the wheel strategy very successfully 3 months in a row. But also, if you look at the 1 year chart, it's been pretty volatile, but it's been very easy to run the wheel strategy on a stock that has such tremendous momentum, and lots of volatility is a good thing overall. And as you acquire more shares, it's just been a very easy stock to trade, really. And now it's heading back up to $20 per share, or not back to, because this is going to be like a all-time high in the last 52 weeks. It's only really been higher back in like 2021. So this stock is going to be $20 per share again, and running the wheel is going to look like this. So I'm going to go to trade SoFi options. We're going to go to sell put, okay, and I'm going to go for an expiration. That's going to be about 30 days out. So August 8th. All right, so I'm going to expand this option right here. You can see that the delta is 0.29. I like to go for delta that's around 0.3. 30 deltas is perfect. Really good bid-ask spread, very tight. Crazy implied volatility, just absolutely super high. So in the next 30 days, you can collect like crazy amount of premium. So 2% would be like 34, 4% would be 68. So this is like a 5% return in a month. I'm just doing some back of the envelope math. So it's going to be about 5% return. And yeah, it's amazing. It has tight bid-ask spread. The stock actually is a stock that you want to own. The financial strength is really good. The profitability of the company is great. Growing revenue year over year, strong balance sheet, and it's a fintech disruptor taking over market share. So all the reasons to trade SoFi. Now here's step number one. You want to sell a put option. The stock's roughly $18.57 right now, 18.5. You want to target a 30 delta put. So that's the sweet spot. That's exactly why I'm showing you the 17 put right here, because this is essentially $1.50 lower than where the stock is trading at right now. So you get a nice discount and you get a 5% return. So you get a discount and a good return. So it's like crazy. It's so good. So of course the delta here, for those that don't know, delta is a Greek letter that basically option traders use to measure how much an option's price will move for every dollar that the stock moves. So an option with a 30 delta on the trading platform will say 0.3, and that means that SoFi will move 30 cents for every dollar that SoFi moves. So the option will be moving by 30 cents. This also technically means that there is about a 30% chance that a 30 delta option will go into the money by expiration. So if there's a 30% chance of it going into the money, that means there's a 70% chance that it won't go into the money. So you have a 70% chance of winning and a 30% chance of losing. And the 30% chance of losing is a good thing because you get assigned. So you see how this is such an amazing strategy where it's basically difficult to lose. You basically can't lose, right? So it's just amazing. So the expiration date that I went for is about 30 days out. I think 30 days is like the most simple. So if you're watching this in the future, then just go for like an option that's like 4 weeks from expiration. And the good news is actually 30-day mark is like right here. And basically there's a lot of time decay, which is a good thing because if you are an option seller, then the decay works in your favor. So it's a good thing that it's, decaying fast. You get to collect the premium immediately, so it enters your account, it's cash in your account. So if you want to go shopping with it or go to Costco or whatever, then you're good to do that. And here's basically what you should be doing. You're getting paid to potentially buy SoFi at a discount. That cash is yours right away. If the stock stays above the strike price, well, nothing. That cash is still yours, nothing happens. If the stock drops below, well, you have to buy shares, which you pretty much want it anyway, right? So it's not a big deal. So it's like a win-win for you. 30 Delta, again, is just that sweet spot. You're going to get assigned 30% of the time. So you have a really good mix of premium and then, fairly low chance of assignment. And even if assigned, you're good, right? You want to do that because you go into step number 2, which is if you get assigned, that's good news. So always remember, getting assigned is good news if it's a stock that you want to own anyways. So you're doing the wheel strategy like I'm telling you to do in this video, then you shouldn't be afraid of assignment because SoFi is a good company, so you should be excited. So when assignment happens, the stock drops below your strike price, you buy 100 shares per contract, right? So if you sold 5 contracts, you will get assigned 500 shares. You got paid premium, and now you get to own the stock at a discount. So again, you don't have to buy SoFi for $18.50. You don't have to buy it at this price, right? Instead, you buy it for this price, the $17 strike price. Here's a quick example. If you were to be selling a put option on a stock that is essentially 105 and you sold the, a put option at 100. Essentially, when you sell a put option that's below the current price of the stock or the market price, well, you're getting a discount, right? So imagine a stock that's at 105 and you sell 100 put, then you get a $5 discount. Same thing with SoFi. What we're doing now is we're getting a $1.50 discount because we're going from $18.50 to $17. So you get a discount, which is amazing, but also you get a further discount via the premium that you collect. So if you say that you collect a $2 premium, then the cost basis here would be 98. This is the blueprint for any stock, not just SoFi. You can do this on a lot of different stocks. Now going back down to SoFi, it's the same exact situation. So if SoFi stock's at $18.50 and then you sell a 17 put option, but if you collect $1.50, right, in our case, we're collecting 81 cents. But if you were to collect $1.50, which you can do if you go out farther in terms of date. So if I go to September 19 right now, then yeah, it's going to get closer to $1.50, right? But anyways, for example purposes, you see that here's the stock price, here's your strike price, and then you further even go down, your cost base is even lower because you're collecting premium. So it goes down by the premium amount. So overpowered strategy. Like this is like the best strategy to get consistent income. Like I'm a bit sick right now, but I'm like pretty excited for you to do this. I think you're going to make a ton of money. I love to see students win. It's just amazing. And by the way, if you want to become a student, then it's always the first link in the description. So let's say that, for example, SoFi falls to 16, you're going to have to buy shares at 17, no matter what. That's the strike price. But again, that's fine because your real cost is $15.50, but you will still get assigned, right? The real cost doesn't matter. So you're going to get assigned at 17 no matter what, but you can still be up. So if it ends right here, you will get assigned because you get assigned at 17, but your cost basis is lower. So you basically still made money. All right. Now in step 3 is if you're assigned, then you own shares, right? Now you have 100 shares. So what do you do next? Well, you sell call options above your cost basis. So remember, at this step, your cost basis is whatever you bought the stock for minus the total premium collected. So I target 30 deltas, okay, for calls. That's the same thing as selling puts. It's really that simple. You go 30-30, right? I even have something called the dog strategy in my Discord community. I don't really share it on YouTube. I have some information in Discord that's like just different. I want to make different and valuable content that's not available everywhere. So I have something called the dog strategy, but it's based off the rules of 30. I love the number 30 for option trading. 30 days to expiration, 30 delta. Those are just like magic numbers, right? So yeah, stick to 30 delta for covered calls as well. So once you're assigned, go for 30 delta. And yeah, you're going to collect premium 2 times. So you collect the premium when selling puts, you collect the premium with the covered calls. And there's 2 outcomes that can happen, and both are very good. So here's the market price. Say it's at 16. Let's say the first case is that SoFi stays below the strike price until expiration. Well, you're good. Nothing happens, right? You get to keep the premium. You keep the shares, just sell another call option. And next month, you just keep doing it as many times as needed. Now, scenario number 2 is the stock goes above your call strike price, right? So it rises a lot and it goes above your sell call. So SoFi goes above strike price and you're forced to sell 100 shares at $17.50. Again, that's pretty good because if I go up here, you will know that our cost basis is essentially $15.50, right? So we sold puts to get in, so it's $15.50, and then we sold covered calls to get out. So what we actually end up making is from $15.50 to $17.50, and again, I didn't even calculate the premium. So if you got paid $1, then you got out at $18.50 technically, right? Because you're striking $17.50. So you can go from $15.50 to $18.50. You can see how this will really add up. So you will get called away, by the way, at expiration. You'll get called away and you'll sell your shares and you'll make money on premium plus the stock appreciating. So at that point, you just start the wheel all over again, but this time you have more capital, so you're like snowballing your account, you're compounding it. So here's like a real example. SoFi, let's say you're starting the wheel, trading at $18.50. You sell a 17 put 30 days out, you collect $120, and basically that's your return. You have $120, and the capital that you're putting up, by the way, if you're wondering like, well, how much capital do I need and how efficient is this? Well, you're making $120 on 1,700, so it's a 7% return in 30 days. If it's signed and then you buy 100 shares at 17, right, your real cost is $15.80. I just made it a little bit more real here, made it a little bit lower premiums to be very real, to be exactly realistic. So then you sell a 18 covered call, you collect another $100. So here's how the math works out on the wheel strategy, right? Rewind this if you have to. But the math is this: you have initially premium 120 on the sell put. Now you have a sell call, so it's another $100. So you collected $220, right? So if it's called away at 18, your return is really going to be well over $200 divided by the capital that you put up, which is now going down as well, which gets you a return, as you see on the screen, of roughly 15%. So this would happen over 2 months, right? Because the sell put would happen in the first month and the covered call that you would get assigned on would happen in the second month. So you would have a 15% return in 2 months in this example. Now let's talk about how much money that you would need to actually make $10,000 a month, because I know that is the title of the video and that's really important for you because that's the outcome that you want to achieve, right? The capital that you would need would be roughly $200,000 to $300,000. $10,000 a month is about 5% of $200,000. It's about 3.33% of $300,000. So that's the type of portfolio that you would need to make $10,000 a month. So I wouldn't say it's little, but it's also not that much. And many of my students that have $100,000, they have a really clear path to getting to this point of $200,000 to $300,000 in their accounts. So if you're targeting 3 to 5% monthly return, then you would eventually get there in a reasonable amount of time, especially if you can add some money along the way. You would need to learn option trading anyways. So this is like very viable for anyone to really get to within the next 5 years, even if you have a smaller portfolio. Like the minimum that I work with would be someone that has $25,000. So even that person, if they're adding money and compounding, can get to retirement within 10 years, which is a very good accomplishment. If you diversify across 8 to 12 stocks, you really need to do that because you can't just have SoFi. Of course, SoFi has to be like part of your portfolio, but not the entire amount. So I would recommend smart position sizing. I talk about that in many of my videos. And for example, it can be like 25,000. So if you have $250,000, you can put 25K into the position. I would say 10% max. But for some other stocks that I covered recent video on NVIDIA using the wheel strategy. You can check out on my channel. I talked about you can go heavier into that. Something like 20% is fine, right? So yeah, you want to target $800 to $1,200 a month from SoFi alone, but then repeat this strategy for other stocks, the ones that I cover specifically. I hope that you enjoyed this video. Make sure to subscribe, like the video, comment if you have any questions, and thanks so much for watching.